Welcome to The Explainer. We're here to unpack the big stories hiding inside the numbers.
So let's get right into it. We're talking about Exact Sciences, the company behind that game-changing Cologuard cancer test. It's a really fascinating story, a classic case of huge, explosive growth on one side, but a really tough road to actually making a profit on the other. And, well, there's a surprise ending that just changed everything.
Okay, so first up, let's look at the bull case, the story of incredible growth that had so many investors buzzing. And honestly, on the surface, the company's performance looked absolutely spectacular. For the full year 2025, the company pulled in a staggering $3.25 billion in revenue. That's an 18% jump from the year before. I mean, any company would kill for that kind of growth rate.
And this wasn't some fluke. The momentum was actually building. If you zoom in on just the last quarter of the year, revenue shot up 23% compared to the same time in 2024. So this wasn't just growth, it was accelerating growth.
And, the company's own leadership was super optimistic. The chairman and CEO, Kevin Conroy, was out there painting this picture of a future with really strong sustained growth. He was banking on their main products and a whole pipeline of new tests.
But, and this is a big but, here's where the story gets really complicated. For all that cash pouring in the front door, none of it was actually dropping to the bottom line. And this is what was making investors pretty nervous.
So even with that sales boom, the company still reported a net loss of $208 million for the year. Just think about that for a second. Over $3 billion in sales, and they were still more than $200 million in the red. And what's worse, the trend was actually heading in the wrong direction. I mean, they almost broke even in the second quarter, which looked great. But then the losses just ballooned through the rest of the year, hitting $86 million in the fourth quarter alone. So the big question is, where was all that money going? Well, a huge chunk of it was being plowed right back into research and development. They were spending a ton of money to develop the next generation of cancer tests, like their OncoDetect test for something called molecular residual disease, or MRD for short.
Okay, so you've got this conflicting picture, right? On one hand, a high-growth sales machine, but on the other, a furnace that's just burning through cash. So what did the financial analysts on Wall Street make of all this?
And what's really telling is the analyst consensus. Check this out. An overwhelming majority, we're talking 20 out of 22, rated the stock a hold. Basically, Wall Street was collectively just shrugging its shoulders, totally unsure if the growth story or the profitability problem was going to win out in the end.
And their price targets really reflected that caution. You can just see how tightly packed they are, right? The low estimate was $105, and the average was just a tiny bit above that. The experts just didn't see much room for the stock to run up in the near future.
But then, right as investors are carefully trying to weigh the good against the bad, the whole game board gets completely flipped upside down by a move nobody really saw coming.
On November 19th, 2025, the company drops an announcement. It had entered into a definitive merger agreement. Just like that, the debate was over.
And the buyer? It was Abbott, a huge, established giant in the healthcare world. They clearly saw something that made them willing to look right past all those current losses.
Now here's the crucial part. They offered to buy every single share of Exact Sciences for $105 in cash. Remember that low-end price target from the analysts? Abbott just walked in and said, yep, we'll pay that, right now, to everyone.
So this leaves us with one massive question. Why would Abbott pay top dollar, a price that analysts thought had almost no short-term upside, for a company that was still losing hundreds of millions of dollars?
Well, the answer is pretty clear when you think about it. Abbott wasn't buying the company's current financials. They were buying its future. They immediately got Cologuard, a dominant product pulling in almost $2.5 billion a year. They also instantly owned a super cutting-edge pipeline of future blockbuster tests. And for a giant company like Abbott, it's often way faster and even cheaper to just buy that kind of proven innovation than to try and build it all from scratch. So this deal gave investors a nice, clean exit and handed Abbott a powerful new engine for growth. It really highlights a huge trend we're seeing in the industry. And it leaves us with one final thought to chew on. In a world that's moving this fast, is it just a better strategy for the industry titans to buy the future instead of trying to build it themselves?